We'd like to welcome you to the Peak Financial Freedom Hour. I'm Dan Almond with my partner Jim Files, and we'd like to thank everyone for listening to us over the years. If you're a new listener, thank you for joining in. The goal for the Peak Financial Freedom Hour is to provide retirees and people getting ready to retire with enough information to start helping to make those decisions that will give them the highest probability for a successful retirement. That's what we do. We only work with retirees and those people planning to retire in the next year for the most part. And we're very successful in educating you and them on all the options that are out there. And it really comes down to then creating an actual plan. And people say, well, I already have a plan, Dan and Jim. I have a 401k plan. I have an IRA plan. I have a brokerage plan. I have an advisor. Well, those are not plans. Those are accounts. You have a 401k account. You have an IRA account. You have a brokerage account. You get statements from them, but there's no plan. A plan has to do with putting every single thing in writing that will now show you how much risk you want to take and to position you to never take more risk than that, to show you where your income is going to come from, to show you how much tax you're going to pay, to put in detail writing what your fees are, and then to be able to show how much money can potentially be passed on to beneficiaries. That's what a plan is, and that's what a plan ultimately should do for you. We know very few, if any of you, have this because in the last 60 years of our combined experience, we've met with 4,000 people. Only 3 people have had an actual plan. If you ran that down, that means 0% of people have a plan, which means you don't have a plan. But if you had everything in writing, just think about how much less you'd worry about the money. And that's what we do. We put these plans together. So many of you listen to us for years. If you need help, have questions, simply dial pound 250 on your cell phone and say the keyword money. Pound 250, say the keyword money. You can even talk to our staff and see if an appointment would benefit you to be able to create an actual written retirement income plan. So, Jim, let's start off with a financial wisdom quote or quotes of the week.
This comes from Warren Buffett. It says, chains of habit are too light to be felt until they are too heavy to be broken. When it comes from Buffett, I mean, he's the greatest investor of our time. And what he's kind of referring to here is what we talk about every day in our practice is that in order to have a successful retirement, you have to figure out how to de-risk your portfolio as you age. And we'll take Warren Buffett as an example. Him and Charlie Munger, his partner for 55 years, created what they call their own little index, right? It's a little Buffett index. And what it was, it's their little formulas they put together. And they take the capitalization value of the stock market divided by the GDP. And that number they're looking for is a fairly valued market from their perspective. That number is about 85%. Today it's running about 222%. That is why Warren Buffett over the last year has taken $382 billion of his stock investment and moved it into cash and treasury bonds. That's $382 billion, not billion. Now, why has he done that? He's done it 3 times in history over the last 70 years. And each time he's done it, the market has subsequently crashed between 25 and 50%. He doesn't know when the market's going to crash. He does know the market is overvalued and there's too many indicators to stipulate that this market is going to reset. And he wants to be in a position to buy at a lower price, right? The guy's 95 years old, but he understands that history will repeat itself. And then what we're trying to do here is making sure clients do not make a financial mistake, that they don't make an error right now. And how do we reposition them so that we can get them enough income for the rest of their life? Because if they lose a bunch of money, they're not going to be able to get there.
Exactly. And you always say that multiple times a day. Clients are trying to find ways to avoid mistakes that can ruin their retirement. That's what they're trying to find. How do I not make those mistakes? Because every single person that we meet with, if they're 55, 60, 65, or 70, they come in, we meet with them for the first time, and they all have certain regrets, or they all think they've made bad decisions in the past that going to tremendously affect them. The good news is when we meet with them and we put a plan together, if we can now make their plan successful from this point forward, they never have to worry about any of that stuff that's happened before. We can wash it out. So you led us perfectly into what today's show is going to be about. It's called our retirement checklist. And it's how do you go through a list of things to verify are you doing the right things? I'm going to add one thing to this, and it's because I met with clients and they thought they were doing the right thing based on the advice they've been given by their advisor. But mathematically, it was proven that they did the exact opposite thing. And I find this a lot to happen in what consumers are gravitating more to do now based on advisors' recommendation, and that is Roth conversions.
Yep.
I was an enrolled agent with IRS for 30 years. I'm an accredited tax advisor. I'm a certified financial planner. I've never recommended anyone ever do a Roth conversion. I have, to my wife and I, we probably have 3 million plus in deferred IRA accounts. We've never done a Roth IRA conversion. I will never do a Roth IRA conversion unless something changes drastically. So these clients that came in, they saved a significant amount of money and they're worried about taxes at retirement because they paid a lot of taxes when they're working. And they got talked into doing 3 years of Roth conversion at the rate of $250,000 per year.
Hmm.
So the $250,000 ends up being added to their normal income while they are doing the Roth conversion. So they were talked into the thought process that do the Roth conversion now, pay the tax now, because down the road, your taxes are going to be so much higher, you will have a benefit by paying a lower tax rate later. And they really were feeling uneasy because it just sounded so good and it sounds so sexy and exciting, but they knew they could feel in their gut it really wasn't right. So they did their own calculation and showed they asked their CPA if they did the $250,000, how much was it costing them between federal and state tax? It was costing them $85,000 each time they did one of those.
Mhm.
Okay. That comes out to a 35% federal and state tax on those extra contributions to their Roth, right?
Mhm.
And they had to pay for the 85,000 out of other assets because they had to roll over the
Yeah.
250,000. Now they had to use other assets they had to cash out and pay more tax on just to pay the dang $85,000 of taxes. So it was killing them. So they said, well, we still don't see how that was a bad decision. So I did an analysis and I said, okay, if you wouldn't have done your Roth conversion and you just would have put together a plan that we would have taken out a normal amount of income from your IRAs every year over your lifetime, and we created a plan that gave you $300,000 a year of income, which they freaked out about because they thought, oh my gosh, taxes. Their total tax was going to be 18% for federal and state.
Killer.
18%. So
Yeah.
should they have paid 35% to do the dumb Roth conversions?
Nope.
No, pretty simple, black and white. And they were just stunned that it was that simple.
Well, the problem is that people advertise on the internet, advisory firms advertise, do a Roth
Seminars.
conversion, right? They all do because it's a way to get you into their office, right?
And it sounds sexy and
It does.
exciting. And it sounds so good. How
Exactly.
can I hose the government? Pay
Yeah.
taxes now to
Yeah.
pay less taxes later.
Yep. Well, there is no trick to this, right? The government usually wins in the end because they have the iron stick, right? They're the ones that are setting the tax rates, and they know in the end that if you do this, it is good for them.
Well,
It's
Jim,
great for them.
why does the government let you convert an IRA to a Roth? Not because it's good for you, it's because
No,
it's good for them. You pay
exactly.
them 85 grand up front in taxes today on your 250,000. Why in the heck would anybody want to do that?
Just like Social Security, the government will tell you wait till 70, but we can show you in 95% of the cases or more, it's better to take Social Security earlier. The government wants you to die before they pay you, right? Or pay you less. So the government isn't on your side, and that's why they're allowing this. But people don't understand it. It just sounds good. The advisor sits in front of them. They do the conversion. The advisor has the money under assets under management. They get a fee for it, and it all works out for them, right?
Well, and the advisors that are working and focusing on Roth conversions, like you said, it's just a way to market because it sounds so sexy and exciting. The issue is those people probably shouldn't even be giving the advice to convert an IRA to Roth because that's giving tax advice.
That's right.
They're not a tax advisor. It's against the law for them to give tax advice, and yet they're out there doing this. If someone who works with Roth conversions would do a calculation and say, okay, if you don't do a Roth conversion and you build out a regular income plan, here's the amount of tax you're going to pay. And it came out to 18%. And then they did the calculation to say, if you do your Roth conversion, you're going to pay 35%. Would anyone ever do a Roth conversion if they provided that type of data?
No, but they're not getting tax advice. They're not. So they're just thinking, oh, great, I don't have to pay as much tax in the future. I can defer taxes. But they forget about they're giving a big hunk of their money away right up front. They're never going to recover from unless they get stellar rates of return on that Roth because there's no way to recover the money.
Yep. Now, I did a calculation because they said, well, can't you do something that'll make us feel good about that decision that we rolled the money to a Roth? Literally, they asked me that. And I said, okay, let's do another calculation. So I did another calculation and I showed because they have that money in the Roth, some of the money would come out tax free. So instead of 18%, their total tax rate was now going to be 16%. So they did save 2%.
Yeah.
But they paid 35 flipping percent just to get the money over.
Yeah.
So, and it's one of the things I am so passionate about telling people to make sure they have all the data before they do this, because in these people's cases, there was no benefit. It cost them to transfer and convert the money from their IRA to their Roth. It cost them. So when you look at making the right decisions and having a checklist, it's kind of like giving you rules. And when you save money for retirement, you had rules you live by, and that's what let you be successful because you worked, you didn't overspend, you didn't have consumer debt, you kept saving money in your 401k, you did it month after month, you never looked at it, you didn't worry about the volatility, you hung in there and wrote it out, knowing at some point down the road you're going to need the assets. And you want to get the highest rate of return possible so you have the highest asset base. So by following those rules, they were very simple. Keep saving, don't stop saving, don't watch it, don't make all kinds of changes. You ended up having this pile of money in retirement. The issue now is you can't use those that same set of rules once you're retired or getting ready to retire because now your whole focus has to be on two things. One, preserving your assets against large losses. Number two, creating the max amount of income that's guaranteed to last for as long as you live regardless of market losses and regardless of how long you live. You're back with Dan Ahmed, Jim Files, the Peak Financial Freedom Hour. And today, the big topic is having a retirement checklist, making sure you have the data and the resources in front of you or the help from someone to make sure you're making the right decisions so you don't screw up your retirement. That's the whole goal. The first thing we talked about at the end of our last segment was Roth conversions and why I have never recommended someone do a Roth conversion. Jim has never recommended someone do a Roth conversion. Why we've never done a Roth conversion with our own money. We went through an example that someone was advised by an advisor who wasn't a tax advisor to convert $250,000 of Roth money, of IRA money each year for the last 3 years into Roths. Well, the 250,000 each year now is in a Roth, but it cost them $85,000 of taxes each year, which was 35% federal and state taxes. We did an analysis and it showed if they wouldn't have done the Roth conversion and just took their income out over their lifetime, their federal and state tax bracket would be 18%. So why would you ever pay double the taxes? It's because no one has done that type of calculation. Just don't do a Roth conversion because someone says it's sexy and exciting. Have every single thing calculated out, meaning what's the tax you're going to pay by doing the conversion, how much you have to have available to pay those taxes, and what's the tax you're going to pay ultimately if you don't do the conversion and you take out your income. And if you have that data, it makes it simple because do you want to pay 35% when you're only going to pay 18%? The answer is no.
Yeah,
Okay.
and if you look at the investment too, how long would it take him even to get that Roth back to even? They're giving away $255,000 of tax money over 3 years, 85,000 times 3,
We had to
right?
get 12% compounded for 3 years.
Yeah, and that's super difficult to do. Super difficult.
So now let's look at the retirement checklist. Why don't you start with number one? So, number one checklist is to know how much risk am I taking right now? Meaning, how much would I lose in the next stock market crash? How can someone figure that out when they right now don't think they have that much risk?
Well, everybody listening right now, if you have money in the stock market, you have substantially more risk than you think you do. Substantially more. We do this every single day. People that come in think they have moderate risk or low risk end up having a risk factor of usually 40% or greater, which means if the market drops by 50%, they're likely going to lose 40% of their money.
And how much sitting in front of you do they really think they could lose if something bad happened right now?
5 or 10%. That's what they think. And that's everybody. So that's 85 to 90% of the people that walk in here for the first time. So if you're listening right now, if there's 10 people listening, there's 8 of you or 9 of you that look just like that. So don't think you look any different because your broker, your advisor, your 401k administrator did not put numbers together for you. We're using outside research tools. We have data that's 97% accurate. It will tell you with a great deal of certainty how much you're going to lose in the next stock market crash. It'll also tell you how much you're going to make in the next bull market. It goes both ways. But because you're getting close to retirement, if you're going to talk with us or you're in retirement, we have to make sure that you don't lose a lot of money or your plan is not going to work. If you're 60 or 65 or older, you don't have recovery time. So if you have a big loss in your portfolio, and you're going to use those assets for income, how is that going to work for you if you lose 20, 30, or 40% of your money?
It'd be very difficult. So we have you run a simple test. It's so simple. You can write it down, but you can actually run it in your head. When you're 40, you would have a different answer to now being 60 or 65. But pretend like right now you're 60 or 65 and you have $2 million of assets right now. Okay. And right now, think about if the market's really good and your $2 million makes a 50% gain, which it could, the $2 million could grow to $3 million. But at the same time, if you can make a 50% gain, it means you could lose 50%, just like what happened in 2000, 1 and 2 in 2007, 8, 9. What if your $2 million dropped 50% and you're down at 1 million? Would the drop down to $1 million hurt you more, or would the increase to $3 million help you more?
Of course, the drop in value is going to devastate your retirement dreams at that age. You can't recover. Well, you can recover if you don't retire when you want to retire. You
Or don't
spend a
take
lot
any
of
income,
money.
or
Yeah,
don't take
just
any
you
income.
don't take any income out, and be as aggressive as you possibly can to get back what you lost because you don't know you're aggressively positioned right now.
See, the key right there, answer this question then, just based on what you just said right there. You brought this up several shows ago, but if someone suffers a 50% loss from 2 million to 1 million, the only way to get it back from 1 million to $2 million is after they've had a heart attack, suffering $1 million loss, is to invest even more
Yeah,
aggressively.
right.
How would they feel then?
They would not feel good, and most people can't do it. You can do it when you're 30 or 40. Why? Because you still have 20 years or 30 years to work. You have a salary, you're not taking your ass you're not using your assets, and you have less money. Now all of a sudden you're 65, you got a lot more money. Those assets have to become your income stream, your paycheck for the rest of your life. You lose 4, 5, 6, 7, $800,000, $1 million. I promise you, you likely won't even stay in the market. You will get out at the wrong time. It'll devastate your retirement that way as well.
Well, think about one thing you just talked about earlier, that you've saved this amount of assets. And unfortunately, everyone has been talked into by Wall Street and the big brokerage firms to look at their retirement savings, their IRAs, their Roths, their brokerage accounts as assets. Those aren't assets. It's what's going to create your income for your lifestyle. So you have to look at your assets as what's going to provide you a pension type of income, because what value are your assets? Well, the value of your assets are whatever they're worth each day, going up or down. What does that mean to your lifestyle? Nothing. If it's up, it really doesn't change your lifestyle. If it's down, it can change your lifestyle. So you have to look at your assets as what you're going to use to create that income stream on a dependable basis that will allow you to live the lifestyle that you want. It's not an asset. It's not that you're this great investor and you invested all this money and you're Warren Buffett. It's not. You saved money to be in a position so you don't have to worry about not having enough income throughout your retirement.
Yeah, that's a good point because people watch their money in the market. And particularly if you're getting close to retirement and you're using those assets for income. And a lot of people don't use it. They're afraid to use it, right? So they kind of live very frugally, even though they have substantial money available. They don't want to use it for income. They don't know how to use it for income because if it's in the market, they're afraid if they take it out, what if the market goes down? What if they take it out when the market's high? Would market go down later on?
Well, here's proof. Have a client, about $4 million of assets.
Yep.
They are so afraid to use their money. Their budget is $6,200 a month for everything, including a teeny bit for travel.
Yeah.
And they're over 65. They want to do things right now. Think about what that's saying. And this is
Yeah.
not uncommon. This happens to so many people, and it's sad. We want to help you. Over $4 million of assets, afraid to take any of it out and trying to live on $6,200 a month. We have to fix that plan. We have to fix that client's lives. You're back with the Peak Financial Freedom Hour. Dan Ahmed, Jim Files here, and we're talking about having a retirement checklist today. And we covered some things such as Roth conversions and why you have to make sure you have calculations done before you ever venture into completing a Roth conversion, because in many cases it might not be the right thing for you. So we need to do that calculation. Second thing we covered was how much risk you're taking and how much could you lose. How about let's attack the next one? That is, how can I know exactly how much income I'm going to need each month? We find it strange that so many people that are retired or getting ready to retire, we meet with them for the first time. And one of the big questions they ask us is, hey, we need you to help us decide how much income we need each month. And Jim and I are kind of like, are you kidding? They go, no, we need help figure out how much income we need each month. And we tease them. We say, are you kidding again? And they go, no. And we say, it's very easy. You have to create a budget. The budget tells us how much income you're going to need each month. And in most people's mind, a budget ends up being restrictive, meaning, oh, we have to keep our spending down below this budget. That's not what a retirement budget is for. A retirement budget is going to be an elastic budget that says, how much do you need to spend to make sure you have enough money to pay for everything you have as far as your wants and needs. So it needs to be not restrictive. It needs to be liberating, but it just sounds strange. So we call it the golden monthly retirement budget. And we want to know how much money minimum you need. So let's say that number, after you fill out a one-page sheet, comes out to $10,000 a month. And that covers a little bit of travel, but they really want to do a lot more travel. So let's say now if we add in another $40,000 a year for travel, it's $13,000 a month. That shows we need a minimum of $13,000 a month of net after-tax income to pay for everything. But even if you create that plan, it's going to be tight, because if their budget's 13,000, they spend 30,000, they have no extra, it's going to be tight. So when we build a plan, we want to build a plan that will give them $16,000 of net after-tax income per month, 17, even $18,000 a month, because we can build a plan with $18,000 a month and their budget, including extra travel, is 13, and they have $5,000 more to spend per month. They're never going to worry about anything in their life, and they're going to feel a lot more comfortable spending some of the money.
People probably have difficulty really interpreting that as you explain it to them because they don't know how to do that. But there are financial instruments we use every single day that will contractually guarantee you that income stream, contractually guarantee it. So when you're putting together a plan, it was interesting when you talked about budget earlier. I had a clients come in last week and they were adamant. They thought they were spending $6,500 a month on their budget. They were adamant, and they did a budget. We have a worksheet. They put the numbers together. I brought it up on the big screen. I went through it with them and they forgot another $4,000, not including travel. It was her hair, her nails. They helped the grandkids out. They give money to the kids every year. There's all these things added up they didn't include in their budget. And when they saw that, they were shocked and they couldn't figure out how we're going to be able to do that without cutting this back. But the neat thing is we could do it. We're putting together a plan right now. We're going to get them that extra money plus an extra $3,500 on top of that per month, an extra 40 grand plus per year of excess cash flow on an after-tax basis. So they can do all the things. Now they're going to come in. They haven't seen this yet. It's going to blow their mind when they actually see it.
Definitely. Well, I think a key to just validate what you're talking about there is 95% of our clients, 95% of our clients have more income now with a plan retired than net income they had when they were working.
Yep.
And the average increase is somewhere between $3,000 and $6,000 more net income per month after taxes. So, how would you like to be one of those 95% of people? And the people listening right now, you're just like our current clients.
Yeah.
As long as you've saved money, you're just like them. How would you like to have more income net after taxes bringing home than you had when you're working, and have that amount be an extra $3,000 to $6,000 more per month? What would that do to someone's life?
But it'll change your life. I mean, you'll be able to do the things you want to do. You won't be hostage to look at your iPhone all day long, looking at the market going up and down. You'll be able to plan trips. You'll be able to go places. You'll be able to help the kids and the grandkids. You'll be able to remodel your kitchen. You can remodel your bathroom. You'll be able to spend money because you've been worried about spending money for 40 years. All of a sudden, we'll liberate you. We'll be able to show you how you can actually take those assets you've saved and put them into an income plan and in a plan where we're going to de-risk your portfolio at the same time to know that you can spend the money and not ever run out of money.
Well, and here's our offer. If you would like to have a free plan created for you to find out, can you be one of those 95% people that have more income at retirement? We will literally design a plan for you for free without any obligation. You get to take it home to study it. You get to bring it back and ask questions, and then you get to decide, do you want to implement it? We will never put any pressure or force you to do your plan or charge you any fees to do this planning for you. So there's no cost. Just dial pound 250 on your cell phone, say the keyword money, pound 250, say the keyword money. We will build you a plan. There's no obligation. You get to take it home, and then you can decide, do you want to implement it? Because can we then prove to you that we can make you one of those 95 percenters, one of the clients that have significantly more income at retirement than they had when they're working, $3,000 to $6,000 more to spend per month than they had before.
It's pretty awesome. But again, this is not an extraordinary circumstance. We do this every single day with 95% of the cases we're working with. We can generate a substantial amount of income for those clients. Typically, as you mentioned, Dan, more than they had net income after tax when they were working. It's hard for people to believe that. How's that possible? Let's presume you save some money as well, right? Presume you have a retirement plan of at least $1.5 million or more. And if you have that, we can do that for you. And again, there's no obligation to do that.
Well, and we're saying that number because most people that saved $1.5 million or more, they don't think it's enough to design this type of plan.
No, exactly.
They want to know, do I even qualify for the services? Is there enough to work with? Is my plan going to be successful? And can I be one of those 95 percenters? 95% of the people that have $1.5 million or more are going to succeed.
That's right.
So it gives you these rules to feel comfortable with, because we know you're not feeling comfortable right now. We sit across from people just like you every day that have saved $1 million, $2 million, $3 million, $5 million, $6 million, and they all feel uncomfortable. Maybe 2 out of 100 don't feel uncomfortable. Like, okay, I think I have enough, but they still don't know. But for the vast majority of people, 98%, they feel uncomfortable thinking they haven't saved enough and their plan's not going to work simply because they don't have a plan. Just let us create a plan. It can prove to you whether it's going to create success for you or not. You're back with Dan Ahmed, Jim Files, the Peak Financial Freedom Hour. Thanks for staying with us. Today's show is about having a retirement checklist, and we're talking about things that you need to know, such as one, should you or should you not do a Roth conversion? How much risk you're taking? How much income are you going to need when you retire? And should you have more retired than when you were working? How about this one as a retirement checklist? Do I know which account or accounts I should withdraw from first and how much I should take from each account? That's a huge question because so many people are wondering, okay, how do I use my assets? And if they don't have any help, they don't use their assets, they don't take the income out, it just stays there. So when a plan is created, we're going to show you for the next 30 years where each income source is going to come from, including what assets you should draw from, how much you should take out of each asset, and when you should take the income out of these assets. If you have this type of plan, is it going to make you feel more comfortable that you know what's supposed to happen?
Yeah, because that's key because there are accounts that you defer on. There's accounts that you start taking income on earlier, and it's usually opposite of what people think. It's opposite. Should you draw on your retirement accounts early, or should you wait until till your RMD stage, your required minimum distribution stage, which is usually 73, could be 75 for some people, depending on your age. But when you do the math behind this, and again, because Dan was an enrolled agent for 30 years and an accredited tax advisor, we can provide tax advice. We can tell you from a taxable perspective what makes the most sense. What is the best economic way of drawing income off your assets, and when should that income start? And how do you disperse that money? What type of financial instrument you need to use to disperse that? And how's it going to look for the next 30 years? You get to see that, and you get to see the after tax effect as well.
Definitely. Well, two things that we dispel as far as tax rumors. Number one is in Roth conversions, we do not believe in most cases Roth conversions are beneficial for consumers, including ourselves. We've never done those. The second is when someone tells you it's better to wait to take money from your IRAs when you're 73, that's typically going to hurt you tax wise more than it's going to help you. So we have to make sure we understand some of these rules. Let's look at the next big one, Jim, and that is when in the heck am I supposed to take my Social Security? When I ask 10 different people when I should take Social Security, I get 10 different answers. Well, the only way to find out when you should take Social Security is actually do a true analysis. It's not like what Social Security does when you call them or you go on the website or you listen to their phone recording or you meet with them in person. They're always going to say wait to 70 because you get 8% increases per year. And at age 70, you're going to get your maximum Social Security. Well, everything they just said was true.
That's right.
100%. The problem is if you wait to 70, you gave up all those years of income you could have been getting from 62 or 63 or 64 or 65, and you had to use your own assets. So we run three tests. The first test is how much do you get at 62? How much do you get if you wait to 67? How much do you get if you wait to 70? And of course, 70 is going to be higher. So if that's the only test you run, which is what most people do, they choose 70. But then we have to run the break even test and we look at how much income you'll get from 62 on and how much income you get from 67 on more, and how much income you get from 70 on, which is even more, and figure out where's the break even, meaning how long does it take if you defer to 67 to catch up with all that income you received from 62 on. And typically that's going to be somewhere between 82 and 84. And can you really wait from 62 to 82, 84 to break even with the Social Security? We don't think so. If you wait to 70, you typically have to get to 84 or older to guarantee that you're going to have more money coming in total payments. And no one can guarantee that they're going to live that next 22 years. So at that point, it starts showing that you probably should take Social Security earlier for most people. We're not making a recommendation right now. We need to run this for each person, but we're just explaining the process. Then the third test we run is we take the income you would have received at 62 and we don't spend it and we pretend like we're going to invest it and earn 5%. Then we take the larger amount of income at 67, don't spend it, invest it, and get 5%. Then we take the big, huge number at 70. And we know that the 70 just intellectually is going to outpace saving a smaller amount of money. Well, it's not true. If you take the age 62 smaller amount of money, invest it at 5%, it will typically win for the next 30 years. So in those cases, when should we take Social Security?
Earlier rather than later. But the thing is, we have to prove this to you, right? Now, there's other circumstances that you mentioned, Dan. We have to consider. Are you going to go back to work? There's other things, but 95% of the math will tell you in almost every single case, take it earlier, not later. If not, you are going to give your money to the government. The government is going to withhold spending money on you. They're going to hope that you either die or that you die early because getting to that break-even point is very difficult. It was out in the mid-80s, Dan. It's really difficult.
Definitely. Okay, how about another retirement checklist question? That is, have I addressed longevity risks so I don't outlive my money? we find of the people that come in and meet with us for their first meeting, their second opinion, to determine if we are going to be a good fit for them, we find that 99% plus of those people have not addressed longevity risk in any way, shape, or form unless they have a big pension. And they really didn't address it. They just were lucky enough to have the benefit of a big pension. If they don't have a big pension, then almost all the people have their money invested in some form of diversified portfolio, a certain percent of stocks, 50, 60, 70, 80, 90% of stocks or stock mutual funds, maybe some bonds, and they're letting this volatile portfolio, they can go up and down in value, be what they're going to use to create this supposedly dependable level of income for as long as they live. It's not going to work. So they have not addressed longevity risk. The way you attack and address and succeed in combating longevity risk is to have income that's contractually guaranteed to be paid to you for as long as you live, that can never run out, no matter how long you live, no matter how much the stock market crashes, no matter what you earn on your account, they're always going to pay it because you need to buy income insurance. Income insurance now is what will address longevity risk in the only way that'll make you feel comfortable.
There's two risks, Dan. There's longevity risk and there is market risk. So how do you get rid of market risk and how do you get rid of longevity risk? There is one financial instrument we're talking about right now that does exactly that. There is no market risk. There is no interest rate risk. You can't lose money if the market goes down. You cannot lose money if interest rates go down. And you solve the longevity risk. Longevity risk is how long you live, and also has to do with your health, right? That means how long you're going to live. And you have to make sure that there's enough income that's going to sustain your lifestyles for as long as you live. And the only way to solve longevity risk and market risk is through this product we're talking about.
One, you got to make sure you're planning for whoever you think is going to the longest in the family.
Yeah.
Right? Make sure that's done. So hopefully you enjoyed the show. If you have questions, make sure you give us a call, pound 250, and say the keyword money.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.